Hello and welcome to ET Now. You're watching IPO Central, and the company in focus today is Shadowfax Technology. It's a new age third-party logistics company. And joining me today is Abhishek Bansal, who's the founder and CEO of the company, and Vaibhav Khandelwal, who's the co-founder and CTO of the company. The company's IPO is opening on Jan 20th, closes on 22nd, price between 118 to 124 rupees. It's a total IPO size of nearly 1900 crores. That gives the company a value of little over 7100 crores at the upper end of the price band. Abhishek, thank you very much for joining us on IPO Central. You are into a third-party logistics, a profitable one, I would say, and without much dilution. So give us a sense of your business model first, how you've been able to, leverage scale and technology together.
Yeah. We are the largest new age third-party logistics company in this country today. We service anything and everything which is getting delivered to our doorstep. So be it e-commerce, be it quick commerce, be it food delivery, any platform that you can order from, Shadowfax essentially delivers to customers' doorstep. We are probably one of its kind sort of a model where we have built a very robust technology and process which spans across more than 2,500 cities of the country, where we are delivering to customers' doorstep. And you think about any category ranging from 10-minute delivery to a same-day delivery to intercity delivery, we specialize in that. Our model today comprises of a massive, what we call as a hybrid mesh network, where essentially we have last mile facilities, close to about 4,300 last mile and first mile facilities that we have, where basically parcels reach, delivery partners come, pick it up and deliver to the end customer. We call our model as a right asset model, okay? We have taken very judicious call in ensuring that some of these facilities that we set up, the sortation centers, we invest our own assets, we invest our own technology into that, while ensuring that all the trucking ecosystem, all the last mile ecosystem is crowdsourced and an asset-light sort of a manner. With this, we have proven an extremely capital efficient model to ensure that as we scale, we stay profitable. Over the last couple of years, we have been growing at about 32.5% CAGR basis. We have been profitable for 10 back-to-back quarters now. And this year in the H1, we have recorded a growth of close to about 68% year on year while expanding our profitability. Our core USP, our competitive advantage, what we call is how we execute last mile. In any digital transaction, close to 50% of your cost is always last mile. We believe through our unique differentiated technology and the way we manage last mile through a crowdsourcing sort of a platform, we believe we have built one of the most efficient last mile technologies in the country today.
How do you, leverage technology to ensure that the last mile cost is much lower, Vaibhav? You have designed the entire tech part of it. How do you look at it from that point of view? Why and how is a question which I think the street would be looking at, why your last mile cost is much lower than the peers or competition?
So see, the important part is that we are the largest crowdsourced gig platform that is there in the 3PL ecosystem that is present. And the benefit that we get from working with gig platform workers is that it is the kind of flexibility, it is the kind of cost advantage that we are able to drive in there. So if you look at under the hood of our technology layer, any gig worker on our platform can just onboard within 5 minutes, and that too with proper KYC. We have integrated with Aadhaar APIs to be able to extract all the information of that user and validate the selfie of the user on a real-time basis using our AI engine, so that we are absolutely sure that the right person is there. Now our payouts engine is where we have spent a lot of our energies as well. Now it's an entirely gamified ecosystem which rewards riders basis their efforts. So your payout is dependent on the distance, the density, the demand-supply gap that exists. And on dynamic parameters, we adjust this payout to ensure that riders are rewarded efficiently for their effort. At the same time, as our densities increase, our operating leverage also starts to kick in. So for example, if I am delivering a number of parcels in Dharavi, it requires much more effort for me to deliver. Whereas if I'm delivering a number of parcels in a single apartment building, it requires relatively lesser effort. So our dynamic payout engine actually takes advantage of this to give us the operating leverage.
You directly interact with the gig economy. For the last couple of weeks and months, we have those debates going on about 10-minute delivery things. And since you manage last mile delivery not only for e-commerce but also for quick commerce, I just want to ask you: is there really a pressure on gig workers with respect to a deadline of 10 minutes?
That's an interesting question in current times. There is no timer, there are no SLAs, there are no penalties on our platform or what we have seen in our competitor platforms as well. Essentially, 10-minute delivery in this country is enabled through a massive network of dark stores and by bringing inventory closer to the customers. 10-minute delivery is something which customers love, and that's why customers have been ordering from there. But essentially, it is the density of the dark stores which is enabling that delivery and the efficient processes that the consumer companies have set up within their dark stores. Last mile happens fast because the stores and the inventory is very, very close to the customer.
You're raising 1,000 crores in primary.
Yeah.
You're one of the few companies, new age companies, who have raised 1,200 crores in the entire history of the company. Yeah. And of that, you've only utilized around 700 odd crores for capex and technology. Still sitting on 500 crores in cash, and you're raising additional 1,000 crores. Yeah. So why are you raising 1,000 crores?
See, we have a huge belief in the growth opportunity in this country. As per our market report partner, Ritzier, India's e-commerce market as well as the hyperlocal market is expected to grow anywhere between 22 to 27% on a CAGR basis over the next 5 years. We want to invest in infrastructure, we want to invest in capacities, automation, enter into newer pin codes where we are not present today, and set up that capacity for the growth. We are building a platform where we believe the growth that we have delivered historically is going to continue as we gain market share over the next few years. Another very, very important aspect that we are today building for is basically ensuring that how do a small seller, how does a small brand come online and basically order or fulfills a transaction through our platform. For that, we are massively investing in sales team, we are building platforms, we are investing in technology to ensure that the growth that we have historically delivered probably will deliver even a faster growth than that over the next couple of years.
How is technology able to navigate this growth, and how scalable have you made this system for yourself, Vaibhav?
So, see, the interesting part or the beauty of our engine is that it is very localized. So, see, in a country like India, there are a lot of different demographics, there are a lot of different disruptions at times that happen. Our technology is scalable at each micro market level. So on every micro market level, our algorithms optimize for the right demand and supply matching out there. And with respect to, see, from a growth standpoint, since the entire decade, one of our important investments has been on how do we match this demand and supply. See, we work with multitude of demand sources, be it food, be it quick commerce, be it regular parcels, and they have different demand timings as well. So we have mastered that art on how do we manage our supply so that at one point in time they can work with quick commerce, at other point in time they can work on regular e-commerce parcels.
I'm looking at your EBITDA numbers, 64 crores of EBITDA. This is the normal EBITDA, not the adjusted one, like others talk about, and profitability of nearly 21 crores for the first half of the year. You have an EBITDA margin of nearly 3.5%. In this business, as you scale up, is there a scope to increase the EBITDA margins?
Yeah, absolutely. First of all, just to answer, see, one of the reasons we have been profitable at this scale and we have showed continued profitability as we have grown over the last few years has been our huge focus on creating differentiated services, more value-added services. Today, one of those services being like reverse logistics. We are the market leaders in reverse logistics. Reverse is a very, very important component of any e-commerce transaction. It is important to get it right, and it is a very difficult transaction because you have to do an open box pickup at the customer doorstep. We have built our leadership in that. And typically, when you build value-added services in logistics, that is where you have a differentiator through deeper tech integrations, through deeper technology interventions with your customers. Moving forward, see, logistics is a business of operating leverage. There is a huge entry barrier because first you have to set up a network. You have to ensure that you build a network which is present in every city of the country. You need to get your trucks over there, irrespective. Even if you, like today, if we open a new city, even if one order comes to that city, we have to send probably a truck with just one shipment just to serve that city. This is a business where as you grow, as you add more volumes, it directly contributes to your utilization of your network. And there is a setup cost, and post that, it is basically the operating leverage in a business like logistics in this country. So as we grow, we expect very, very healthy EBITDA numbers over the next 4 to 5 years.
Give me also a sense of the scalability. You've been growing at 60% in the first half, more than 60% in the first half, basically. Do you see this growth to be sustainable? Or have you reached out, is it just a beginning, and as the e-commerce and the quick commerce volumes increase, this growth can be sustained for the next couple of years?
See, historically, over the last 2 years, between FY23 to 25, we grew at a 32% CAGR.
Yeah.
I think that's a more realistic number of growth. And that's what one should think about, because the market is growing at anywhere between 22 to 27% on a CAGR basis. We'll grow slightly faster because the 3PL industry is going to grow faster than that. So I think those are the kind of things you should be expecting in the future. Well, this has been a good year, but we believe a healthy 30% plus growth can be possible in this sort of a market. Now, having said that, see, if we look at where the growth is coming from, okay, one of the biggest drivers for growth today in this country is essentially the smaller brands and the D2C brands. Over there, they completely depend on third-party logistics for their fulfillment. And that is where we see people are now buying from Instagram, people are going using video commerce to grow fast. So I think those are the kind of numbers that are driving the growth in the industry today, and that is something which is going to benefit the entire 3PL industry.
You know, today you are a 3PL for many of the big clients, I mean the Flipkarts, the Swiggis, the Eternals, and Amazons of the world, and Meeshos of the world. Do you see yourself now, expanding yourself into a point-to-point logistics within intercity kind of thing? Because you have competitors coming in this in that space, and since you are a 3PL in any ways, do you see that as one of the opportunities for you?
Yeah, absolutely. See, we will do whatever it takes where an end customer like you and me will order from. Anywhere where the demand is coming for the end customer, we will do that. There might be newer models that will come in. We will definitely be the first company to attack this entire segment. See, in India, if you look at the last 12 to 14 years, every 3 years, a new model comes up. There was traditional e-commerce, then there was omni-channel based commerce, then there was social commerce, then came quick commerce. For India's digital penetration to go up, today only 7-8% of the retail sales happen online. We have a huge belief that this number will probably double up as per our market research reports over the next 4 to 5 years. And this number is actually much higher if you look at some of the Western geographies as well. So we have a huge belief that India's digital penetration will go up. Existing models will grow, newer models will come in. One thing you can stay assured is that we as an organization are going to be the first ones to actually solve for that business.
How do you, when you are interacting with your clients, how do you, price your services with them? We've seen other logistics companies loss-making. They're not able to push prices across. Of course, they're asset-heavy as well in that sense. So when it comes to pricing and providing flexible services, which is your USP, how do you do that?
See, our pricing is a completely pay-per-use model. On the pricing front, pricing depends on multiple factors. It depends on the SLA of the delivery. It depends on the average weight of the item. It depends on the distance through which we want to transfer that shipment. So there are multiple factors.
But these are standards for other delivery companies as well, right?
They are standard, but I'm just trying to explain how our pricing structure typically works. Now, the way and again, we are not saying that we want to increase our pricing on, in India, if you have to open up the market, if you have to get the digital penetration to be up, the pricing
has to come down.
The logistics has to become very, very efficient. Okay. So our view is to add profitability, and we don't need to increase pricing necessarily. What you need is operating leverage. You need to become extremely efficient. And on our case, we have the advantage of having a very unique technology-driven asset-light sort of a model on the last mile as well as on the middle mile, where we get operating leverage and we get a cost advantage as well. The second thing for a logistics company like ours to really create value is how do you again go into value-added services? How do you do differentiated services? One of the services which we started, which is probably the fastest growing service today, is our venturing into same-day and next-day delivery services. Like how we built Reverse as a value-added service, we have come up with this unique concept where any D2C brand can fulfill an order within the city in a very, very cost-effective manner with us in anywhere between 6 to 8 hour bucket, or if you are in a different city, through airline connections, we will ship it and we will deliver the order on a next day basis in more than 20 cities of the country. So those are the kind of value-added services that customers are looking for. Those are the kind of things which help logistics companies grow their market share, gain control over the profitability, and doing these different things makes us stand apart.
Vaibhav, you have a tech stack which is leveraging technology and scale together. How are you using AI as part of it?
So I'll take one example of our reverse logistics piece. Now, in reverse logistics, the delivery boy has to come and do a quality check of the product that is there. We have leveraged AI in this to ensure that as soon as the delivery boy clicks an image of the product, we validate it whether it is the correct product or not. Now, understand from a delivery boy perspective, a delivery boy may not understand what is the difference between a sneaker, a Jordan, or a regular shoe, but an AI engine can. A delivery boy does not know what a Tommy Hilfiger t-shirt looks like and what is a Lacoste logo, but an AI engine can actually identify whether it is the correct brand or not. That is what we have leveraged. Now, the beauty of the solution is that it runs on a real-time basis at the doorstep of the customer itself. So as soon as you click the images, our AI engine is able to validate whether it is correct product or not. And these are this is one example. Another example that we are doing with leveraging AI on our front is how we heal our network. So see, we run a hybrid mesh network across 2,500 towns of the country. Not an easy stance, because in a country like India, there are so many disruptions that happen on a daily basis. There could be floods, there could be some different demographics, there could be some political processions happening at different point in time. Our network auto-heals itself if it detects that there is blockage at any particular node. So for example, if there is a flood in Mumbai, it will automatically heal that the new shipment should be routed either to Surat or to Pune or to different node, so that we are safeguarded from the disruptions that happen in a particular point. So these are some of the examples where we have been leveraging AI. The regular way of working, the innovations in Gen AI that have come up, which has led to very fast iteration pace for us, is also a massive boost for us. So by far, we are in this industry, we are the most agile team that is there. So as Abhishek mentioned, if there is any new instance that we would want to capture, any new business model that we would want to capture, we and our clients both trust that it will be Shadowfax.
And is that technology, can it be monetized as well? Because you are into logistics, and that means that you've mapped cities and villages and everything, and that that technology can be monetized as an additional app or any other manner in which. So is that monetizable as well?
That's a very fair point, and our mapping layer, something which we have built across our 2 billion delivery parameters that we have so far, that gives us a very good picture of what the different localities and towns of the country look like. See, at the moment, our focus is to leverage that to optimize our operations in a much more dynamic manner, to be able to take the right decisions at right point in time. At moving forward, there could be conversations on monetization, so there could be thoughts on maybe open sourcing it as well, so that the larger, see, these are foundational blocks of the economy. If more companies get access to such important underlying technologies and frameworks, it can really boost the overall infrastructure of this country. So these are some of our thoughts. Haven't narrowed down on what the future would be, but the focus is on building these solutions to optimize our network.
So over a period of time, maybe last 3 years or something, you have 3 businesses, Express, Hyperlocal, and the other logistics business. And Express has come down from 73% or to 68%. Do you see Hyperlocal to be a larger driver of revenue going forward? And which gives you much better margin, Hyperlocal or Express?
That's a good question. See, what has happened over the last couple of years is that the quick commerce industry has grown very, very rapidly, and that is what is also reflecting a bit of in our numbers. Moving forward, we believe that both e-commerce and quick commerce will grow at a continued pace. While in e-commerce, we have a huge opportunity to gain market share, to acquire D2C brands, to go and go after the long tail sellers. Quick commerce is something which we believe is going to have a continued growth over the next 4 or 5 years. We do not foresee significant changes in this split of the business versus what it is today. From a profitability standpoint, I would say that both the businesses are in a steady state equally profitable for us.
From a margin point of view?
From a margin point of view. From a net margin standpoint, in e-commerce, while you have a massive infrastructure, you have a hubs, trucking, and a lot of fixed cost, hyperlocal and quick commerce is an extremely last mile oriented platform play, where the cost infused in the business is significantly lower versus on the e-commerce side. So it's a technology play that we have, where we essentially make margins on every transaction, and the steady state margins, we assume that in the steady state is going to be pretty similar between both the business lines.
What we have seen in the last 4 to 6 quarters is how quick commerce has been aggressive in not only expanding dark stores, but also going into new cities.
Yes.
Now, you will have to follow your clients wherever they're going.
Exactly.
Simple as that. What is the incremental cost for you when you follow them to new cities? Because initially you will also be making losses on those.
Yeah, so actually it's quite interesting. The cost to enter a new city is minimal for us because we are already present through our other networks and other businesses. See, e-commerce today, our presence is in more than 2,500 cities and towns of the country. Hyperlocal quick commerce is all a subset of that. So entering into a new city is not a bottleneck for us. We already have our gig platform working over there. We already have hundreds of partners already working in every city. So entering into a new city is not a new investment, and that is why we have been able to grow. Like when quick commerce wave came in, we were the first company to enter into this. We have grown very, very rapidly, and you can see our margins have expanded despite a very healthy growth in the quick commerce vertical.
And finally, you have the new labor code which has come into play. It impacts 3PL logistics as well, like any other company there. What could be the impact for you in the third quarter? Because it's what we're seeing is that every company is now reporting changes because of the institute giving FAQs about how to expense those costs basically.
While we have started provisioning in the Q3, we don't see significant impact on our margins. Typically, as costs go up or down, it essentially gets passed on to our customers, which is the businesses at the end of the day. We do not see significant impact happening on our steady state margins because of this. While some of these provisions we have started happening, we are still awaiting final outcomes of the law, which should be finalized probably by the end of this quarter.
Abhishek and Vaibhav, thank you very much for joining us today on IPO Central. Your IPO is opening on Jan 28th and closes on 22nd, price between 118 to 124, and it's a 1,907 crore IPO that gives you a company value of little over 7,100 crores. Thank you very much for joining us today on IPO Central.